Thank you for joining us today for CyberCube's Cyber Predictions 2025 webinar, a live event that promises an insightful discussion ahead. I'm Yvette Essen, Head of Communications and Market Engagement for CyberCube, and I'm delighted to be your hostess. As the cyber industry continues to evolve, forecasting future trends becomes increasingly critical. Each year, CyberCube releases its Cyber Predictions Report, and today's webinar examines the latest insights published at the start of this year. Our predictions are shaped by CyberCube's diverse team of experts across a wide variety of fields, including data science, threat intelligence, actuarial science, software engineering, and insurance. Today, we'll explore standout trends anticipated for 2025, touching on themes such as artificial intelligence, the evolution of cyber underwriting, and the pivotal role of brokers in driving growth within the SME market. You can delve deeper into these predictions by downloading the report from our website. The QR code should now be visible on the screen. This is a live event, so we encourage you to become involved. There's an opportunity to ask questions throughout the session, and we'll have a dedicated Q&A session at the end. This webinar is about sharing our thoughts on the year ahead. With this in mind, we've prepared a poll for you to share your predictions on what you think will happen in the insurance market in 2025. The poll will close 15 minutes before the webinar ends, and we'll share the results with you at the end of the webinar. So showing up on your screen should be the questions. Question number 1. Which trend will have the most significant impact on the cyber risk landscape in 2025? We've given you 3 options based on the report. 1. Artificial intelligence agents will create leverage for threat actors in scaling widespread cyber attacks. Option number 2. Quantum computing will revolutionize cybersecurity and disrupt cyber insurance. And finally, cross-sector partnerships will drive efficiency and improve cyber risk management. On to our second poll, question number 2. Which of these actions from the insurance sector will be the most important in supporting the sustainability of the cyber market? Again, we have 3 options. Cyber insurers will improve data collection to manage accumulations more effectively. Or will it be policy terms and data capture will evolve to address the more nuanced exposure landscape? Finally, will you vote for brokers? Will they be unlocking cyber insurance growth for small and medium-sized businesses? Thank you all for answering those questions. I'm looking forward to seeing the results. But what do our guests think? I'm fortunate to be joined by a panel of esteemed guests who bring invaluable perspectives from across the cyber industry. Remotely from America are Dan Pallady, Cyber Actuary at Cowbell, and Scott Stransky, Managing Director and Head of the Marsh McLennan Cyber Risk Intelligence Center. And here in the studio, I am pleased to introduce Steve Ridley. Steve is a cyber insurance expert and consultant. Now, gentlemen, can I please ask you to each briefly describe your role? Steve, I'm going to start with you.
Yeah, sure. Thanks, Yvette, and thanks for having me here today. Really kind of excited to be sharing kind of some of my thoughts with the audience today. My background is I have 15 years worth of experience in the cyber market, starting out on the broking side of things, kind of when the market looked very, very different to what it does today. But the last 10, 11 years of my career have been on the underwriting side of the market, with the last 6 or 7 of those leading the cyber insurance portfolios at Aviva and Hiscox, respectively.
Brilliant. Great. Thank you. Can I ask you, Dan, to pick up the baton there and tell us a little bit about your role?
Yeah. So I've got roughly 15 years experience as well in the insurance market. I started off in, more broadly speaking, the PL insurance and reinsurance market. But really for the last 3 odd years, I've been working here at Cowbell Cyber. So we're we're focused primarily on the SME cyber market. We've got a suite of products in both the US and the UK. And in this role, I'm tasked with managing the actuarial function. So that includes a couple of hats, but it's mainly product and portfolio pricing, portfolio management, and a little bit of aggregation and reinsurance strategy. So I do a couple things, but it's been a very stimulating role, particularly being an insurtech startup.
Great, thank you. And Scott?
First of all, thank you for having me. In my role, I really do risk quantification across Marsh McLennan. I work with Marsh, Guy Carpenter, and Oliver Wyman to help them understand financial consequences of cyber incidents. I've been in the risk modeling space for about 18 years and dealing with cyber risk modeling in particular for over 11 years.
Great. So fantastic panel of guests here. We do have some 500 people registered today for this webinar, so I'm expecting lots of good questions and a really dynamic and engaging conversation. I mean, this webinar is our predictions webinar, so let's all start with a prediction. I'd really like to hear your views on what you think will be the standout event that happens, the standout element that takes place in this year. What is your prediction for 2025 for the cyber market? And I'll start with you, Steve.
Yeah, sure. So mine is that geopolitics will continue to play a really big part in how cyber as a peril and the crime elements to it evolve. Over the last 4 to 5, 6 years, we've seen quite a rapid evolution of how things have gone. And we've just seen this week a new president reinstated in America. And if we look back to the previous Trump administration was when the cyber market was experiencing some of its deterioration in terms of the loss performance, not kind of drawing any particular cause and effect within this. And then in the time afterwards, we've seen a lull within that. But what we also saw at the same time was Russia invading Ukraine, and then that kind of leading to a drop in the volume of cyber attacks. And with Trump coming back in, he said that kind of ending the war in Ukraine has been kind of one of his initial objectives to achieve. And I think it'll be really interesting to see, kind of, as and when that does happen, if we see an inversion of that pattern of if the conflict does cease, whether we see more attention going back into the cyber world as we see this heightened tension around tariffs and things like that, and the reinstigation of the tensions with China, whether that leads to an increase in activity, all remains to be seen. So I think it's definitely something we're going to need to keep a watching brief on in this year and for the next 4.
Fascinating observation. Scott, he's picked your new president as one to watch. Geopolitical risk there being a real talking point. Do you agree, or do you have your own different prediction on what we should be focusing on in 2025?
I certainly agree. However, since I don't want to repeat what he said, I'll share maybe a slightly different angle, and that is physical damage from cyber. We've seen a lot of issues related to digital, for example, records lost, downtime, ransomware, and more. But what we've started to see is more and more of cyber bleeding into the real world, the physical world. And this is an area where analytics have a ways to evolve. It's where I know CyberCube is working in this, we're working in this. A lot of folks are working towards analytics to help companies understand their risk from physical damage due to cyber. There's a lot of things that could happen. It's fires, floods, liability risk, health risk, life risk, and beyond. And I think it's an area that needs more exploration, because it's something that the bad actors are actively trying to pursue. And we're hearing it from our clients all the time. What is my risk due to physical scenarios? So I think that's an area that actually could be related to the geopolitical risk. But I think it's maybe an outcome of some of the bad actors' discussions that are going on behind the scenes.
Great. Dan, in your opinion, what should we be looking out for in 2025?
I don't disagree with either of the points made by Scott or Stephen, but I mean, I think more holistically and more broadly speaking, I see an increased shift towards the risk management component post-bind, most notably through, I guess, further leveraging of the technographic insights that we have. So this is a trend that has probably been building momentum across the ecosystem for some time now, all the way from the individual policies at the primary level up to the retro and the ILS markets. But nevertheless, I think the adoption of these practices has lagged somewhat Uh, partly as a result of the 2022 hard market, which made cyber risk attractive on rate alone for a period. It also allowed us to hit some lofty growth projections, even though the penetration rates weren't necessarily increasing or keeping pace with what was projected. So fast forward to the past 2 years, what we've got now is a softer rating dynamics, somewhat elevated claims trends. And all of that is to say there's a shifted focus towards a more tech-enabled model, both in the underwriting and the risk management component of the business. We also now have a couple of years of market maturity. So there's greater visibility into these technographic data points, and it serves to, I guess, strengthen some of the confidence in the tech underwriting model. So I see more of that shift in 2025.
Great observations and predictions, gentlemen. I'd like to touch upon them in a bit more detail. But Dan, I'm going to start with you there because you were talking about the market conditions. You mentioned the reinsurance market, the ILS market. We've just had the 1/1 renewal season. What are your observations of the state of the market now? You mentioned soft there, but can you sort of expand on where you see the market in its cycle at the moment? Dan, I'll ask you to embellish there.
I see a market seeking to keep pace with very bullish growth projections. And I don't inherently disagree with the long-term view of the cyber market as being highly relevant and, significant on a global scale. But in the short term, we haven't necessarily kept pace with the more bullish side of those projections. And this is mainly due to the softer rating environment that we're certainly seeing right now. And more importantly, a slower than expected penetration rates. And granted, I speak more specifically to the SME component of the market because that's where I'm most fixated. But I think the point on cyber penetration rates stands all the way up the chain. So the extent to which the market is keeping pace with these projections, it mainly depends on its ability to capitalize on the emerging opportunities right now, because it's not happening on rate alone. So what we see is an acceleration of new products, new services embedded within the insurance products, and of course, a push into new markets. So these rating dynamics, I guess, to a certain degree, are pushing a more innovative approach. And this is actually a net gain to the industry and maybe forcing the hand of some of the more established shops that might have a more outdated model. But I'll emphasize that particularly in the SME market, there's a significant opportunity in the ways of standardization of basic resiliency measures and education. And these types of things can find a natural home within the insurance placement process and possibly within the insurance product itself.
Steve, I see you nodding there.
Yeah, I mean, I agree kind of pretty much completely with everything that Dan's just said there. You know, we are in a persistently soft market at the minute, in London especially, kind of being kind of the area that I can talk to with greatest clarity. He referenced the hard market period of 22 and how that then became a really attractive thing for new entrants to be coming in to capitalize on that rating environment. And what we've seen in the few years since is there has been a flood of new capacity into the market, and the demand hasn't increased at a level to match that capacity increase that we've seen, certainly from a London perspective. And actually, we're still not doing a good enough job as a market of educating customers or getting people to see the true value in cyber insurance, because underinsurance is endemic across the whole kind of sphere of companies that we see here. Dan mentioned that it is most acute in the SME space, and that's definitely something that we see, with an estimated 10% optimistically of SMEs buying cyber insurance in the UK. But even when we look at larger companies, they're not necessarily buying limit to the extent that they need to match up to the risks that they might face. So there's still work that we need to do as an industry to really show these companies kind of why there is such a need to be taking action against these. And some of the actions that Dan spoke about are definitely the right things to be looking at. So how do we standardize a lot more of what we're doing? How do we talk in a consistent kind of manner to businesses in a way that then gives them confidence in us as an industry, that we know what we're doing in this space, having differentiated policy language, different ways of assessing risk, different ways of quantifying what we're doing. only adds to confusion and uncertainty, and that stops people from engaging in it. So there's still some steps that we need as an industry to take in order to combat some of those things.
And we'll definitely be talking about SMEs and particularly the role of the broker with regards to that market growth. Interesting, both of you so far seem to think it's a soft market. Scott, in your opinion, how would you describe the market?
Yes, I was recently looking at some statistics from recent renewals for Marsh clients. And it's good news for the buyers, actually, quite good news. Rates year over year are still going down just a little bit on average, maybe a single-digit % decrease in rates. We also see that companies are able to get higher limits. Nearly a quarter of our clients in recent renewals increased their limits, which I think is, again, it's great for resilience because in many cases, as was already mentioned, limits aren't sufficient for the risk that's out there today. So it's great that they're able to get higher limits because in case they do have an issue, they'll be able to recover better from that issue. So I do think we're in a buyer's market today, and that should help increase the take-up rates. Everybody's saying the take-up rates are low. Now that rates are coming down, hopefully more companies will see the value in purchasing cyber insurance.
So I want to jump back in. Whilst I think we are kind of very much in soft market kind of conditions, I don't think it's going to take much to turn that dial. That we're very much approaching the bottom in the sense of the rate that we've seen eroded over the last 18 months or so. Yeah, it was at this time last year where people were predicting that there would be a slight uptick in the market towards the back end of last year. But actually we just saw that continue to drag down. And I think that when we do hit that inversion point, it's going to be quite an acute one. I don't think we're going to suddenly hit a bottom and then kind of plateau and have a period of consistency. I think when there is a turn in the market, it will be a large jump in rate and change in terms as and when it does happen. Probably not to the extremes that we saw in 2021, 22, but I think it will be a more significant increase or change.
But what is it going to take? Is it going to be an event? We obviously had CrowdStrike last year, which obviously wasn't malicious but didn't have that desired impact of a hardening market. In your opinion, what will it take?
So I don't think it will be a large event on its own because, like I said, we've seen some large events, not just CrowdStrike, but CDK, Change, a number of these other kind of smaller but still significant events. I think it will be when we see the attritional kind of losses change as well. I spoke earlier about some of the things that may well lead to that. And we are seeing not just rate kind of be impacted by the soft market conditions. We are seeing kind of the underwriting terms, policy language broaden as well. So I think all of that combined, once the exposure change earns through, we may well see a deterioration in the underlying performance, which may then, if there is one or two larger events, which I would predict we may well see again next year, that's when we'll then see that flip.
Okay. Scott, what do you think it will take to change this market?
And so I think it's key to differentiate between quote-unquote big events and quote-unquote big events for the insurance industry. A few events were already mentioned that from a media perspective, they were big. They made the news all the time. But from an insurance perspective, maybe not so bad. So I think what it will take is an event that hits the insurance industry. Not exactly sure what that's going to look like, whether it's a physical damage event like I mentioned earlier, or a more traditional, so to speak, cyber type of event in the digital world. But I think an event that causes a lot of insured loss will have a different impact than an event that is a media noteworthy type of event.
Dan, in your opinion?
Yeah, I would echo a few of the things that were said already. But I mean, if I think just along simple terms, I mean, what does it take for a hard market? Some sort of major event, loss activity, or just simply a reduction in market capacity, either by the carriers pulling out, either post-event, or maybe the market just growing beyond the capacity of the current providers. I don't see a huge cyber type event in the near term as highly likely. And I would echo what Scott said as, you have to distinguish between, the big on economic terms or headline terms versus big insofar as how they proliferate into the cyber industry. One point that I would make, though, about the rating environment is you have to consider how much the exposure of the underlying risk is in flux as well. And there is a silver lining here. And I'm not trying to pretend that I'm, overly optimistic about the cyber risk or overly pessimistic. I just want to make the point that organizations are strengthening their cybersecurity posture, and the educational efforts around the industry are much more widespread. So these are net positive trends, even within a softer rating environment. The exact quantification of that depends on who you talk to, but there's some element of offset to a softer rating environment there, just based on that fact in itself.
Dan, can we explore that a little bit more about what companies are doing? I mean, in terms of predictions, people often talk about AI. We certainly do in this report as well. We've talked about the role of AI and the impact that it can have on more significant attacks. We've said with regard to the threat landscape, there may be an increase of attacks with AI. I mean, in everyone's opinion, how prepared is the cyber reinsurance market to address more sophisticated AI-driven attacks? I'll start with you there, Dan.
How prepared is it? There's still a long way to go. But the use cases for the AI-based models, or just AI in general in our industry, is pretty far-reaching. For one thing, they can improve the threat detection, they can improve the loss prediction, and then the post-loss type claims assessment is also fairly significant. So the first two are probably of the most significant value to SME, in my estimation, in particular for the first-time insurance buyers. So if you think of, let's take the micro space, so entities under $30 million in annual revenue. The mere act of insurance purchasing can be pretty significant to their risk posture. So the threat detection seems obvious, obviously with an increase in AI derivatives for social engineering. There's a significant opportunity for this type of AI to help with the threat detection and screening at the very point of contact for these types of entities. So I see a huge opportunity there for not only the insurance products and the insurance carriers, but the brokers as well as helping in improving that risk posture overall for the underlying entities. As far as the accuracy of the monitoring, that's another obvious point. I mean, it feeds into the models that I use pretty much every day. And keep in mind, for the SME entities in particular, we do have to leverage a little bit of benchmark type estimations where the data might be a little bit lacking. So there's a gap that can potentially be filled by the AI. But to loop back to your original question, how much does the industry have to do to be able to accurately leverage it? I think there's a lot of work to be done. But I am hopeful that we can get those things in place through, I guess, a robust sort of data integration of all of those tools.
Steve, AI, is it a threat? Is it an opportunity?
It's both. Right? I struggle to get too excited or too concerned about kind of the risks of AI, because I think the gangs that are kind of proliferating most of these attacks, they'll use what's tried and tested and what works. I think AI may have an impact from a social engineering perspective, in the sense of helping them to craft kind of better phishing emails or things that are more believable, more likely to be clicked on. But that's not something that, to me, represents a fundamental threat to the insurance industry, or needs a fundamental change in how businesses react to things, because it still comes down to making sure that the people in your technology is able to deal with those social engineering phishing attacks. We have seen kind of some evolution on that. So there was the big engineering firm whose Hong Kong office was targeted with a really sophisticated deepfake attack, where the finance manager joined a Teams call with what was a load of deepfake people pretending to be the CEO, CFO, whoever it was, and made significant monetary payments as a result. But that is something that's going to be the preserve of the big companies, who then have other measures in place to be protecting themselves. If we think about the masses, so the SME market, which is where we need to be most concerned, I think, in terms of that pure attritional loss perspective. They're not going to need to worry about deepfake attacks against them necessarily in that same way. It is going to be the much more low-level, basic style attacks that they will continue to see because they still work. And it's how do we kind of focus on raising that bar to stop it being such a big deal.
Wow, that sounds quite frightening what you can do with AI nowadays. But Scott, I'd be quite interested in hearing from your perspective, from a sort of data modeling perspective. How are you using AI to fight back?
So it may sound a little bit trivial, but we're using it in a few key ways. The first is actually the most trivial. And one of the things that we see is we get a lot of data about insureds that doesn't even have URLs associated with the insured or information about the insured. And we're able to use some AI tools to actually enhance exposure data that we can then feed into our modeling. So that's kind of the most trivial thing that we're doing with AI. But from a more advanced perspective, what we're doing is taking a lot of our own historical claims data, which is free-form text in many cases, maybe emails or PDFs, Excel files, these documents that people put together and save, and trying to extract very important information from those data sets. And the AI tools are quite useful for that. In the past, we would have had to hire somebody to literally read through thousands of pages of documents per claim to try to extract the 10 or 20 numbers that are actually very important from that. And that's a very tedious job. People are going to hate our company if we hire somebody just to do that. AI is actually very good at that. So we're able to feed all of these documents and folders and files through the AI tools and extract information like what was the root cause of the incident, how much was the loss, did they use a certain vendor to help with the recovery, how much was the hourly rate of these vendors. All of that key information that we could then use in our analytics and modeling can be extracted using AI. So that's one of the key things that we're doing from an AI perspective.
Great. Moving from AI, I'd like to talk a little bit about brokers and the SME market, as we've all raised that as a focal point for 2025. With SMEs identified as being underinsured, can we talk about the role of the broker and what strategies they should be using to help unlock this growth potential? Dan, I'll start with you.
Yeah, when it comes to the small, especially micro businesses, the brokers aren't really just selling the policies; they're also actually selling a cyber education. So the entities, often lack in both their cybersecurity posture, but also their adequate, just basic awareness of cyber risk. So making education a critical part of that process actually pays dividends for the market and also for carriers such as Cowbell that endeavors to underwrite those risks. The problem with this market is they're also highly sensitive to pricing. So it creates a challenge in achieving market penetration, sometimes at equitable rates. These types of business might not see cyber insurance necessarily as a need to have, but more like a little bit of a nice to have. So really, it's a game of reducing the exposure pre-bind, and that's where the brokers play an invaluable role. So some sort of integration of cybersecurity improvement measures into the submission process is really where I see the market going. It's already been done to a large extent. Some of the more tech-enabled brokers, some of the platforms that feed directly into the SME marketplace. But I'll just echo that encouraging these minor adjustments to the systems before binding a policy, these businesses actually reduce their exposure significantly. And it not only enhances their resiliency, but it also makes cyber insurance as a product much more equitable and, much more affordable for them by the time that they approach the actual carrier market.
Yeah, so I think brokers have a really, really tough job in this space. If we think about the SMEs in particular, and when you're looking at the bottom end of S within that as well, like these are companies that might be paying a couple of £1,000, dollars, whatever, for their premium. The brokers might be earning a couple of £100, a few £100 commission in it. So actually kind of being able to engage with a customer and have that conversation is really tough in that space. I think we need to do a better job at getting a really good commoditized kind of solution for those really small customers where it is just a simple process. But as you start going up through the size bands within that, I think it needs a bit of a step change in how how we engage with it. We've seen time and again that brokers will try running campaigns to sell more to their customers, but we're not really moving the dial on it. And I saw a video the other day of Jordan Belfont, the Wolf of Wall Street, being interviewed at a conference or something. And someone stood up in the audience and asked him to sell him a pen, kind of thing, as the question. And Jordan Belfont kind of then went on to talk a bit about this and how kind of many people just take it the wrong way. So they take the pen, and if you do it as that sales exercise, they'll start talking about how wonderful the pen is, how it does X, Y, and Z and has all these features. But actually that just never really lands, because if you just list a load of features and talk about why this thing is so great or so valuable, people don't necessarily engage with it. It all starts with asking the questions and getting to the crux of what is the problem that you're trying to solve for businesses. And I think too often when it comes to selling cyber to small businesses in particular, it is very much presented as that. It's here's this product, it will do X, Y, Z for you. And the customer just thinks, well, I don't need that. I've got an IT company that manages my security for me. I'm too small to be hacked. And that's when you start to get these objections. But actually, you start by having a conversation with a customer and ask some questions around what would be the impact to you if you couldn't access your computer systems for a period of time? What would be the impact if you lost your customer data? If you start to bring out kind of what this impact is to the business and how insurance can be there to plug a gap and help and to stop it from being an issue, that is when I then think we'll have much more success. But appreciating, again, when these policies might not necessarily be paying the largest premiums, actually having the time and being able to justify having that conversation is a really tough thing to then be thinking about.
Dan, is there anything else that brokers can do to help SMEs understand their exposure?
Well, I think Stephen made two interesting points. So on the one hand, yes, there's, there needs to be, particularly the products perhaps need to be better explained to the underlying entities. And this is understandable because typically you're dealing with an entity that might not have a huge understanding of their cybersecurity posture. They might not have a huge understanding of the value proposition of a cyber insurance policy. They might not even completely understand why they need a cyber insurance policy if they have, just any number of protection, antivirus, whatever off the plate sort of cybersecurity measures they might be leveraging. Where I see more value, actually, and this might loop back a little bit to the AI conversation, is just data ingestion. The SME data tends to be very messy at the point of submission. It tends to be oftentimes inaccurate. I think the AI tools can do a lot of the low-hanging fruit, the stuff that Scott pointed out in their own modeling, can offer a lot of value to these SME type entities. So when they send their submission or whatever data over to the broker to be able to submit to our type of entity, there's an opportunity for the brokers to ingest that, scrub it, and put it in a form where there's better data integration across from one step to another and potentially all the way up the value chain. It doesn't seem necessarily as complex as other tools that we could use, but it would be of huge value for the market all in itself, just for the ease of the data touch points that come through our systems.
Scott, Dan's touched on a couple of things there. He's touched on data, he's touched on tools. What sort of data, what tools are out there can brokers use to help increase their insurance penetration?
First, I'm going to share an anecdote. We were talking to an insurance carrier, I'm not going to name the carrier, where they said they write a lot of small business policies, but they seem to think that a very large percentage, maybe even half of those companies that they're insuring for cyber don't even realize they have cyber insurance because it's packaged in with so many other types of coverage. So I think there's a lot of education that goes around this, that people are paying money for a policy and don't even realize they haven't. We think they should have it, which is good, but they should know they have it so that if there is a cyber incident, they realize that they're covered. As far as data-driven insights and tools, there are a lot of tools out there that are used in this process. I think the simplest thing that we do is we have our self-assessment questionnaire, and that's something that these clients can start to answer. The act of answering that questionnaire actually can make them more secure a loan because they start to say, oh, wow, I didn't even think about that. Because I'm a small business, I didn't realize I had to think about it. But of course, once we get the answers, we can then start to work with them. As was discussed earlier, it's not really just purchasing cyber insurance. That's part of it for sure. But it's also about, okay, which cybersecurity tools don't I have at the moment that I should have, which would give me the most benefit for the investment? And that's what a lot of these models can help us do today. In fact, our own internal model can be used by our clients to say, okay, I don't have MFA yet, I don't have EDR yet, but I'm debating getting one of those two things. I only budget for one. And modeling can help our clients understand, oh, it's better to invest in MFA right now because I'll get a better deal on cyber insurance, I'll have fewer losses, etc. Or maybe it's the opposite. Again, these are what the models can help our clients understand, even for small businesses.
Let's flip this. We've talked about brokers. Let's talk about the underwriting community, and particularly with regards to data and technology. What advancements do we sort of see in terms of technology and data analytics driving change? I mean, this report does predict a sort of more science-driven approach to cyber underwriting. What are we seeing with regard? I'd like you all to answer that one. Whoever would like to pick up first.
Yeah, I can take that first. So I mentioned our cyber self-assessment before. One of the exercises that we took on is correlating the questions in that assessment with loss data to see which of the questions are actually most useful. Maybe some of the questions aren't so useful at all. And that helps us drive towards a more scientific-driven approach. We can make sure that the questions that really matter to risk are being answered by our clients, that we share those with the insurance carriers, and that the insurance carriers understand that, okay, our client answered this question favorably, therefore they're a pretty good risk. Maybe there are a few questions that they either left blank or didn't really answer, but we see that those don't matter so much. And we need to share this information across the insurance industry. So I think absolutely we're shifting towards more of a data and science-driven approach. I will say though, and I like to always give the quote from George Box at one of these webinars, is that all models are wrong, but some are useful. And the idea here is you can't just use the model. And we tell this to our internal folks, our external clients, everybody, that if you just take the model's number as a given, it's probably not the right thing to do. The model is a tool that hopefully gives insight and help towards getting towards the right answer. But I know you all are a modeling company at CyberCube. We do a lot of modeling. It sort of sounds like we're bashing ourselves. We're not bashing ourselves. We're trying to be realistic, that these models are useful tools to help understand the risk from a scientific perspective, but you still need that human interaction, that human intervention as you're underwriting a risk.
Yeah, I agree with that completely. That final point kind of most pertinently, I guess, in that as much as science might become a much greater element to it, there will always be an element of art to this as well. I think the moment we lose that art in any form of insurance is kind of a dark day for the industry, really. I think one of the reasons why we'll see science come much more to the fore this year and kind of looking forward as well is because we're now getting to a point where the major carriers in this space have much greater data maturity within it. We saw the hard market cycle of 21, 22 leading kind of most carriers to re-look at what their data points were, what data they were capturing, how they were able to assess all of that. And now with kind of coming up to 4 years worth of that data, there's much more analysis that you can then perform on that data to look at where is the correlation from a loss perspective against those elements. So we'll see that continuing to grow, as well as using the likes of CyberCube and the platforms that we have through yourselves and other carriers that provide, or other providers that have tooling of a similar nature. That is becoming much more prolific around the industry as well. And kind of we're not just then having it available, but learning how to use it in the best way, how to apply the art to the science that we have there. And that's kind of part of what feeds all of that, I think. But that element of art and underwriting, knowing when's the right time to make a bit of a leap of faith on something, I think will always stay there.
Staying with cyber underwriting, and I'll start with you, Steve. You have talked about art and science. You referenced that. It wasn't actually in this report, so I'm glad you've been reading that. But we've talked here about art and science. How do you see the balance between art and science evolving in the next 5 years? And what skills will underwriters need to thrive in this environment?
Oh, Christ, that's a big question. So I think science will become more and more dominant within it. And it will then kind of follow a bit of the value chain as well. So I spoke earlier on about the need to really commoditize at the small end of things, in the same way that a broker can't be spending ages engaging with a client on that. As underwriters, we don't want to be spending hours underwriting risks that generate very little premium, but equally we want to make sure that there's as accurate as possible loss cost calculation going into it. So we'll see science come much more to the fore in that space. And even then to the larger end, there'll be much more data that we can leverage and start doing the comparisons between companies of what does the risk posture look like and what might that mean for the underlying result. So it will become more dominant, but it ultimately still needs an underwriter to be able to make the decision to apply the art over the top of actually not just thinking about the actuality of what it is at the minute, but what journey are they on? What are the pieces that the science can't tell you, that there aren't data points for? And also kind of that the interaction with the broker as well. That bit is an important part that can't be underplayed within this as well. So we will see a greater move to science having a more dominant effect within it, but that art will always exist, particularly for the larger, more complicated risks.
I guess you're referring there to the broker side. Scott, can I ask you to talk there about art and science?
Yeah. So we're very data driven here at Marsh McLennan, for sure. We want to use as much data as possible. And I think over time, we're getting more and more data. So we divide the world really into two modeling frameworks. One is the attritional risk, which we talked a bit about before. And there, I think that the science can really drive the way because there's so much data on attritional losses from cyber. I think on the cat side, these big events that we haven't really seen too many of, there's going to be more art. There just has to be. And this is an area where we can start to balance the science on the attritional side, more art on the cat side. Over time, we already talked about what the cat might be. If we do see a big cat event, then we can start to even move the cat side more towards science. But I don't think it's as cut and dry as saying, oh, the whole thing is art, the whole thing is science, or it's 50-50. I think different parts of the risk require different balances. And as I'm saying, like where you have more data, you use more data. Where there's less data, there's more art.
Dan, what's your opinion?
I agree with Scott. I think inherently, if we're thinking about the attritional component, there's going to be a move towards more science. And to that effect, I do see a move for there to be more technically savvy underwriters. That's not to say that any of the underwriters out there today are not highly technically savvy, but there's been a gradual shift from, the typical history, maybe for people of more or less my vintage, to have come from the PL product space, which is a little bit more focused on regulatory and liability type exposures, over to the cyberspace. And there's perhaps a little bit of a need for them to not only get the modeling outputs, but to understand them a little bit more, like a modeler would, or an actuary, or a data scientist. It's not to say they don't need the more subjective components, but there's a shift to that one. Now, the flip side of that is perhaps the more technical people that are fixated on the cat space need to maybe embrace a little bit more of an artistic approach. And that's because there hasn't been a million cat events out there. To the extent that there have been cat events, they haven't been the quote unquote big ones at the end of the tail that we're hoping to be able to mine those data points and validate the outputs of, say, CyberCube or any of the other vendors out in the market. Hopefully those two components can ideally find a balance between the art and the science and meet somewhere in the middle. But I agree with what Scott's saying. There's a move to more technical underwriting in the attritional side and maybe a little bit more art in the cat side.
Great. Well, thank you very much. Now, we did say we were going to give the results of our poll, and I can tell you the results are in. So I'm going to go through the results. But again, this is an opportunity for you to ask our panel of experts. So please do submit your questions. I've got quite a few pre-submitted questions, which we'll go on to shortly, as well as the ones that are coming through live now. So let's answer the first poll. The question again was, which trend will have the most significant impact on the cyber risk landscape? Now, 10% of you voted for quantum computing, saying that will revolutionize cybersecurity and disrupt cyber insurance. In second place was 16%, saying cross-sector partnerships will drive efficiency and improve cyber risk management. So the overall majority, 75%, said artificial intelligence agents will create leverage for threat actors in scaling widespread cyber attacks. You did read it here first, so glad we've seen to get a prediction that you will agree with that. Now, this one was quite an interesting. So for the poll results on the next question, which of these actions from the insurance sector will be the most important in supporting the sustainability of the cyber insurance market? And roughly, cyber insurers will improve data collection to manage accumulations. What effectively was pretty much tied with policy terms, and data capture will evolve to address more nuanced exposure landscape. So thank you very much for answering those questions. Now, I am going to move on to the Q&A session. Again, thanks to the many of you who submitted questions in advance. I'm going to touch on those first. Quick fire round to our panelists. Got one on AI. I'm going to give that one to you, Steve. Will AI increase cyber perils?
In the interest of giving it brief, no. It will evolve existing ones. We're going to see the same things will be that the majority of claims that we see, AI may have an influence on them, but I don't see it leading to significant numbers of brand new things that we haven't seen before.
Okay, I'm going to give you another one, actually. Market growth. Will cyber insurance become compulsory? How can we sell more cyber insurance to people who need it?
So no, I don't think it will become compulsory. Thinking from a UK perspective, there's 3 instances in which any form of insurance is mandatory in law. To me, it feels a bit of a leap to go to making it compulsory. So I don't see that being the driver for the market. I think one of the big things that will drive it is getting to a point of having greater consistency and clarity in terms of what we're delivering to customers. In this space, that will be the biggest driver, and arming our brokers with the tools that they need to have better conversations with their customers. That's the thing that will really drive the market.
We have a question here on ransomware. Scott, I'm going to pass that one to you. What differences are you noticing in loss trends, ransomware versus non-ransomware?
Yeah, so there's a lot of loss trends going on. If you look over the past 5 years, ransomware has gone from minuscule amount of the loss back in 2018, let's say, to a great deal of the loss. In fact, perhaps the plurality of the loss nowadays. We see that ransomware is still very important. We see different types of extortion, like double extortion, triple extortion, soon to be quadruple extortion. Not even sure what that would mean. But yes, we do see ransomware taking a larger share of losses. And we see the losses from ransomware increasing. Not as much as it was increasing back in 2021, but it is still increasing nowadays.
Great. Question on social engineering. Dan, as the cyber market matures, do you see stances surrounding social engineering evolving?
So I'll deliberately steer away from commenting on the social engineering coverage, but what I can say is that the risk itself stands to become much more relevant to the cyber market. The attacks are definitely increasing in both frequency and, more importantly, sophistication. So I see this trend continuing through the broader adoption of AI into the threat landscape, which plays conveniently back into the insurance and underwriting strategy that I highlighted before, which focuses on the risk management strategies specifically aimed at perhaps mitigating the social engineering risks. So, if you think of your traditional social engineering, there's this view that because it's human behavior, the best way to combat it is just through simple measures like employee training. You could probably leverage a more real-time tracking of these types of risks as they emerge via the types of data partnerships that we've been talking about earlier, and a lot of the InfoSec type firms and the IR firms, and whatever appropriate cybersecurity firms. So I do see a push towards, I guess, more integrated partnerships in this area as the trends probably trend up throughout 2025 and rise in sophistication as well.
Right. Steve, I've got one for you here. It refers to Change, CDK, CrowdStrike, which we talked about briefly. What do you see in terms of industry language adjustments in response to the events of 2024?
So it's an interesting one. So I think when CrowdStrike happened, there was this kind of view that that was an area of coverage that would kind of really be looked at and tightened up. Actually, we've seen the inverse, I think, where the granting of cover in that space has actually become more prolific, and that's something as well that I should have mentioned earlier as well, that may lead to greater uptake of cyber cover. Is big events, kind of making things more known to people that these things can happen. And I think there's a real challenge for the industry around things like this, where we need to deliver products that give good value to customers. That's the fundamental thing we need to do. We need to provide solutions to cover losses that people are concerned about, but need to make sure that we do it in a measured and sustainable way. And I think that's one of the things that we need to pay particular attention to, because I do believe we will see more events like that. Companies are becoming much more technologically interconnected, and it's that second, third tier of provider that kind of causes me the most concern in terms of points of aggregation within my books of business. I was always less concerned around the big, Microsoft Azure being hit or something like that, but a particular specialist piece of technology that impacted a large proportion of my book in a particular area is always something that I think is of more concern. And I think it's an area where there'll be a lot more focus from a modeling perspective in not just considering the mega events, but actually the mid events and how we get best prepared for those.
Great. So many questions coming in. Thank you very much. We've still got time for a few more. One that's coming live here is with regards to NotPetya. Anyone can jump in. Is a NotPetya-sized attack enough to change the soft market? Has anyone got a view on that?
It depends, I think. Much like CrowdStrike, right? CrowdStrike with a slightly different set of factual circumstances could have led to a much bigger insured loss, which may have led to an increase in the payouts from the insurance industry, which may have led to a change. So there's so many different elements at play within any of these, which is why another thing that I think we'll see more of this year is insurance companies doing a lot more in the way of like counterfactual analysis of these different events and considering if the circumstances were slightly different, what would that impact have been? A NotPetya in its form that it had when it happened, I don't think would have a material impact on the market if it was still largely directed at Ukraine, because most of the market isn't insuring companies in that part of the world. But if there were a similar event that hit the US, the UK, parts of Western Europe, that would more likely have an impact.
Great. Someone's here asked, do we have any predictions regarding non-malicious cyber attacks? I guess that's off the back of CrowdStrike. Dan, Scott, do you have any thoughts on
non-malicious cyber incidents have always been on our mind. We've always contemplated them. And in fact, honestly, I think they're more common than malicious cyber incidents. They may not tend to be as costly as malicious cyber incidents, but they happen all the time. Again, if you make a typo, if you click an email that you're not supposed to click, whatever it happens to be. I do think it's an area that we need to focus on. But if you're looking at attritional risk and looking at claims from attritional losses, that type of event should be included in there already. From a CAT perspective, I'm not sure how much the CAT models have contemplated non-malicious incidents yet, but that's an area certainly for CAT models to focus on going forward.
Yeah, it's a good question. I'm thinking about it at the same time. I think from the attritional side, it's definitely to an extent, it's a driver of frequency. I mean, not a huge one, but the claims tend to be very small, and they aren't really an area of concern for me when I think about the severity coming through our portfolio or anyone else's portfolio for that matter. From the CAT modeling perspective, I mean, I guess most people on this call would be fairly familiar with the CyberCube one. I'm not sure to what extent the non-malicious ones are of the highest concern in those. I think of the scenario classes, and they tend to lean a little bit more towards malicious. But It's definitely something that's considered from both angles. I think we have a good handle on the attritional component. I would defer to my modeling experts for the catastrophic one.
I think it's also an area where the coverage that's given is the most divergent for non-malicious attacks amongst the different carriers. So what a large non-malicious event looks like for one carrier would still be very different to another. So there's a lot more analysis that needs to be done of the underlying policy language to actually ascertain what that impact is.
Gentlemen, it has been a fantastic session today. I'm afraid we've actually run out of time to answer all of these questions, of which there were so many. So thank you to everybody who submitted questions, and we will try and get back to some people with some answers. So it leaves me to say thank you to our esteemed panel of guests for joining us today. Thank you, Steve. Thank you, Dan. Thank you, Scott. And thank you for contributing to today's engaging discussion. I trust you found the webinar insightful. It was based on our predictions report here, which is available on our website. It should actually be showing up on your screens now, but it should be on the resources tab of our website as well, cybercube.com, along with a variety of other reports, blogs, and videos. If you would like to rewatch today's session or share it with colleagues, please keep an eye out for a follow-up email with the recording. For further information on our services, products, or if you have any additional questions, please feel free to email us at info@cybercube.com. On behalf of CyberCube, thank you for joining us today. I'm Yvette Essen.